Hello everyone, we are here to discuss about the case study of Enron, the biggest accounting scandal of 2001. At 2001, Enron was the blueprint for large corporations, boosting 30,000 employees and annual revenue of $100 billion. But by the end of the year, the company had garnered the title of biggest bankruptcy of all time, while Arthur Andersen, one of the big five, suffered as similar fate for their part in the scandal. So, how did the energy giant, once valued as $70 billion, go from winning Fortune's most innovative company for 6 years in a row to bankrupt in the space of just a few months? Here is a story of fraud, corruption, and serious mismanagement. Here is how it happened. For some background, Enron was formed as a result of merger between energy firm Internorth and utility company Houston Natural Gas back in 1985. American Kenley was appointed CEO, and legendary artist Paul Rand, who also made the logos of IBM, UPS, and ABC, designed the now infamous Enron E. The energy market underwent significant deregulation throughout the 90s and 80s, leading to extremely volatile prices and belief that anything was possible. As companies rode the bull market that followed 1987 Black Monday, Enron opened its own trading subsidiary to maximize profitability, and Jeffrey Skilling was appointed CEO of Enron Capital and Trading in 1991. Skilling oversaw the introduction of mark-to-market accounting within the corporation, that is, the practice of valuing yourself based on predictions of their future prices rather than own historical prices, and in short, it basically gave Enron the right to decide their own profits without being held accountable for the accuracy of the valuations. Based on the optimistic calculation, Enron revenue figure began to skyrocket. As 90s wore on, the firm was named on Fortune's best company to work in 2000 as its stock price peaked at $90 a share, and its directors outlined their expectations of even further profits in the near future. As Enron invested hundreds of billions more into the project, both in US and overseas, the company was able to hide these losses behind false estimation of the new asset value. To cover any reported losses and cash flow issues, Enron would borrow money from its SPVs. The crashing of the dot-com bubble in 2000 hit Enron's assets hard, as they had now diversified industries like video on demand and high-speed broadband network. Investors were becoming more conscious of the firm's complex business models, and by early 21, serious questions were being asked of Enron's financial statements. Place stepped down as CEO in February to be replaced by Skilling, with Enron's stock price halving to $40 million in the 6 months it followed amid widespread speculation about the company's accounting methods. Skilling stepped down from the new role in August 21 as Lay returned to his former position. In October 21, Enron announced its first quarterly loss in 4 years of $1 billion from its underperforming assets, and the SEC began a formal investigation into its financial statements. During November, the company revealed it had overstated its profits by $591 million between 1997 and 2000. Meanwhile, over 2,000 of its employees' 401 pension plans were locked for 30 days due to a change in administrator. In 30th of November, the company's stock price hit rock bottom at 26 cents a share, and Enron filed the biggest bankruptcy protection 2 days later on the 2nd of December, marking less than a year since became 7th biggest operations in US. Thousands of employees lost their job, and their shareholders eventually sued banks for conducting deals with Enron. Several executives went on trial for a range of charges related to the company's nefarious activity, including Lay and Skilling. Not exempt from punishment were Enron's auditors. They were found guilty of destroying documents that were of relevance to the SEC, which was the cause to relieve him in no choice but to close. The fiasco saw the United States Senate imposed much tighter regulations to prevent a repeat in future. Undoubtedly, the effects of the Enron scandal are still felt in the finance industry today.
The causes of Enron's bankruptcy is due to the truthfulness, the lack of truthfulness by the management about the health of the company. Enron wanted to be the best at everything it did, and they did have the projected their reputation and their compensation as the most successful executives in the US. The duty that is owed is one of the good faith and the full disclosure. There is no evidence that the Enron CEO told the employees that the stock would probably rise. He also disclosed that he was selling the stocks. Moreover, the employees would not have learned of the stock sales within the days or week as is ordinarily the case. The only investigation surrounding Enron's bankruptcy enabled shareholders to learn the CEO stock sell before 14, 2002, which is when the sell-off would otherwise have been disclosed. The stock was sold to the company to repay money that the CEO owned, expenses under the ordinary director and officers disclosed requirement. It does not have to be reported until 45 days after the end of the company's financial year. And the next thing is interest. The conflicts of the interest and the lack of independence oversights of managers by Enron's board contributed to the firm's collapse. In addition, recent regulatory changes have focused on enhancing the accounting of SPES and the strengthening internal accounting and control system. We reviewed these issues beginning with Enron's board, the conflict of interest between the two roles played by Arthur Andersen and the auditor, but also concerned to Enron. While investigating continues, Enron sought to be salvage its business by While investigation continues, Enron has sought to salvage its business by spinning off various assets. It has filed of Chapter 11 bankruptcy, allowing it to recognize while protected from creditors. Former chief executives and chairman Knightley has resigned and restricted expert Stephen Cooper has been brought in. As core business that the energy trading arms has been tied up in complex deal with UBS Warburg. The bank has not paid for the trading unit, but will share some of the profits with Enron. Enron and the reputations of Arthur Andersen. The revelations of accounting irregularities at Enron is the third quarter of 2001 caused regulations and the media to focus extensive attention on Andersen. The magnitude of the elegant accounting errors combined with Andersen's role and Enron's auditors and the widespread media attention provided a seemingly powerful settings to explore the impact of auditors' reputations on the client market prices around the audit failure. CP investigations, the share price reacting to Andersen clients to various informations events that could lead investors to revise their beliefs regarding Andersen's reputation. Perhaps most damaging of Andersen's reputation was the admissions on January 10, 2002 that employees of the firm had destroyed documents and correspondence related to the Enron's engagement. For a simple S&F 1500 firms, CP responds that in the 3 days window following the shredding announcement and client following the shredding announcement, Andersen's clients experienced a significant of 2.3% market reactions, and this reactions was significantly more negative for a big clients. Andersen Housen office clients were Enron's was headquarters experienced even stronger negative market reacting that Andersen's non-Housen clients. Overall, CP concluded the shredding announcement had a significant impact on the perceived quality of Andersen's audits and the resulting loss of reputations had negative effect on the market values of the firm. In the study, we report news finds that shed lights of the whether this event study evidence of consistency with an auditor reputation. In so doing, we do suggest the auditor's reputations does not matter. As the discussed above, there is an simple evidence that reputation is important to the auditor and their clients. Rather, our purpose is to determine whether the client returns around the Anderson's shattering announcement and related events can be considered even of reputation's effect, or whether the result are confident by other effect.
Accounting fraud using mark-to-market. As a public company, Enron was subject to external sources of governance, including market pressures, oversight by government regulators, and oversight by private entities, including auditors, equity analysts, and credit rating agencies. In this section, we recap the external governance mechanism with emphasis of which the asset theoretically will sell on the future market is reported on the current financial statement. In order to keep appeasing investors to create a consistent profiting situation in the company, even Enron traders were pressured to forecast high future cash flows and a low discount rate on the long-term contract with Enron. The difference between the calculated net present value and the originally paid value was regarded as the profit of Enron. In fact, the net present value reported by Enron might not happen during the future years of the long-term contract. There is no doubt that the projection of the long-term income is overly optimistic and inflated. Special purpose entity. Accounting rule allow a company to exclude a SPE from its own financial statements if an independent party has control by the SPE, and if the independent party owns at least 3% of the SPE, Enron need to find a way to hide
Prisoners' dilemma shown in Enron's case. At the time of the firm's collapse, Enron was engaged in a wide range of activities including energy production and the trading of energy-related commodities and derivatives. As such, many of its activities were potentially subject to oversight by the Commodities and Future Trading Commissions (CFTC) or the Federal Energy Regulatory Commission (FERC). The CFTC's primary mission is to ensure that the commodity futures and options markets operate in an open and competitive manner, while the FERC regulates the interest transmissions and market for energy products. Of course, the primary source of federal oversight for publicly traded firms is the Securities and Exchange Commission's (SEC). We discuss each of these in turn. In the zero-sum game, each party is trying to secure more gains for themselves, even it is the best outcome is cooperating with each other. Obviously, to pursue maximum profits, wrongdoings like accounting frauds will harm the shareholders' interests. Arthur Andersen, as auditor but also a consultant to Enron, has to be responsible for both managers and shareholders, since the provided accounting information has a direct influence on economic benefits of both parties. Clearly, the managers and Arthur Andersen choose betraying the shareholders to maximize their self-interest. Now, let's discuss who was morally responsible for the collapse of Enron. From individuals' angle, as corporate acts are originated in the choice and actions of human individuals, it is these individuals who must be seen as the primary bearers of moral duties and moral responsibility. The chairman of the board, Kenneth Lay, and CEO Jeffrey Skilling is allowed then CFO Andrew Fastone to build private corporate institutions secretly and then transferred them properly illegally. The CFO Andrew Fastone violated his professional ethics and took a crime of malfeasance. When the superior, the chairman of the board of Kenneth Lay and CEO Jeffrey Skilling ordered conceptual employees to carry out an act of both them knowing is wrong.
The warning of Enron's sandal. First, we are going to see about there should be a healthy corporate culture in a company. In Enron's case, its corporate culture played an important role of its collapse. The senior executives believed Enron had to be the best at everything it did, and the shareholders of the board, who were not involved in the saddle, were over optimistic on Enron's operating conditions. When there existed failures and losses in their company performance, what they did was covering up their losses in order to protect their reputations instead of trying to do something to make it correct. The too good to be true should be paid more attention by directors of board in a company. Number 2. A more complete system is needed for our owners, for a company to supervise executive operations and then get the idea of company's operating situations. There is no doubt that more governance from the board may keep Enron from falling to bankruptcy. The boards of directors should pay closer attention on their behavior of management and the way of making money. In addition, Enron's fall also had strikingly bad influence on the whole US economy. Maybe the government also should make the better regulations or rules the economy. Number 3. Mark to market is a plan that Jeffrey Skilling and Andrew Faston forced to pump the stock price cover. The loss attract more investment, but it is impossible to gain in a long run terms. In operation in this law, and so it should be the method of SEC also cause the final saddle. Thus, an accounting system which can disclose more financial information should be created as soon as possible. Number 4. Maybe business ethics is the most easiest point. People doing business should focus as on a loyal agent of employer.
The flaws in Enron should have been spotted from early on, and indeed were periodically commented on by various observers from the early 90s onwards. If independent ethical and corporate governance surveys had been conducted by independent parties, they would have highlighted the growing problems. One would conclude from the survey in 2000 that neither customers, suppliers, financial nor local communities rated Enron's morality in terms of business ethics. Customers and local communities thought they were breaking regulations. Customers and suppliers thought they were probably bending their own rules. Customers, shareholders, suppliers, financiers and local communities thought they were not truly honest. It's clear with the benefit of hindsight that what started out as an imaginative and groundbreaking idea, which transformed the natural gas supply industry, rapidly evolved into megalomaniac vision of creating a world-leading company. Intellectual self-confidence mutated into contempt for traditional business models and created an environment in which top management became divorced from reality. The obsessive focus on driving the share price obscured the lack of basic controls and benchmark, and progressive dishonesty in generating revenue and earnings figures in order to deceive the stock market led to the management deceiving themselves about the true situation. Right up to nearly the end, Enron, compelled with all the regularity requirements, the falling in these regulations led directly to Sarbanes-Oxley. But all the extra reporting in Sarbanes Act didn't prevent the global financial meltdown in 2008 as the bank gamed the regulatory systems.